this computer. What's going on, everybody? It's Fantastic Friday, and we have Mike Zuber from One Rental at a Time. Mike, still looking fresh without the hat. What's going on? Happy Friday.
Dude, fantastic Fridays, man. I love these conversations. That's awesome. I love that.
Yeah, it's good, man. And we had a big week this week.
Yeah, we did.
I mean, mortgage news and CPI and inflation and our Tuesdays and an awesome session with Dion. Yes, Dion talks yesterday.
Yeah.
I mean, I'm tired.
Yeah, man. Every day's Saturday. We're good.
Go take a nap. For some of us. Yeah, for some of us. So everyone, we wanted to talk about something that is really kind of crushing the market right now, which is the 10-year. The 10-year, as you guys all know, that largely speaking, the mortgage is based on 10-year bond rates. And, you know, after Fed Powell's talky talk, we saw those things absolutely skyrocket. Everyone was calling their mortgage brokers saying, can you still lock at the old rate, please? And they're like, nope, it's already up. Yeah. Too bad. So sad.
Sorry.
Yep. Wish we could, but can't. And so the crazy thing is obviously we saw that massive pop in rates. You know, the 10-year went from like a 1.45 to like a 1.57 or a 1.58. Yeah. And for those of you who don't watch that market often, that is a colossally massive move.
Yeah.
Like if you go from 1.42 to 1.45, that's the kind of fluctuation you might see in a day. But that many points, that many bips is just, whew, it's
and
crazy.
It was fast. It happened in about an hour. It happened so fast. You know, as you know, I talk to Matt, the mortgage guy, every week. I'm going to talk to him after this episode, actually. And he sent me text that he had three rate increases in a 4-hour period. That's not normal.
No, nope. Yeah. Nope. And on top of that, the special that we did with him, I think it was last week, where he was talking about somebody with a well into the 700 score.
Couldn't get a yes answer.
Couldn't get a yes.
The world's changing.
Yeah. So Mike, talk to me, you know, when you see that type of a reaction in a market, you know, you're a, trained economist. So when you see that type of a reaction in a market, what does it make you think? I mean, what it made me think as a 9th grade dropout. Like, holy crap.
Well, it's funny when you talk about the 10-year, and I've said this on the Daily Financial News a couple of times, it's performing oddly for lots of reasons.
Yeah.
Let's step back even before Wednesday's jump. Last week, the rates fell. Right. We had CPI last week and PPI this week. So after CPI came in hot. I forget what it was, 6% or something, hotter than expected.
CPI, Consumer Price Index.
Thank you. Right? Yep. I always acronym crazy. Consumer Price Index. It was higher and hotter than expected. But the 10-year went down, and it went down significantly, not quite 12 points. I think it was 6 or 7, but it went down.
It did.
I'm like, that's weird. Mm-hmm. That's odd. So the market is really, it's battling itself. So I'm pontificating that the Fed is a very large and disproportionately large participant in auctions.
Agreed.
Right. I think they're pretty soon going to be the only buyer. And if you're the seller and the buyer and you don't have to make a profit, you can set the price where you want.
That's right.
And I think there's a lot of that going on, because I think naturally speaking, when you think of inflation, both at the consumer, which is now 2 months in a row, it's not like a single blip where you can argue the data is dirty. It's now 2 months in a row. Mm-hmm. You have validation with PPI. You have validation from around the world that this is getting, I was going to say out of hand, but it might be too early to say out of hand. It's just higher and hotter than expected.
Sure.
You would think the 10-year would go up. And it did. And it really, just so everybody realizes, it didn't get hotter after PPI, which came out on Tuesday. It didn't get hotter after Powell's initial Fed speak. It came out during the Q&A.
That's right.
Right. It came out the Q&A after market closed. And that's interesting because people are starting to dig in and really push the Fed. So what did the Fed say that caused the 10-year to jump? Two things. One is it pulled forward interest rate rises, right? A full year.
I know.
And oh, by the way, it pulled forward the quantity. So basically the rate and speed are expected to be higher. I came out when that happened. I said, they're still playing with us. It's going to be 2022, not 2023. And lo and behold, this morning, what's his name? I actually wrote it down for you. James Bullard, St. Louis Fed president.
Saw that.
Came out and said, it's going to happen in 2022. One rental at a time is right. It was really nice of him to say that. That was a joke, folks. Don't go searching for that on Wall Street Journal. He didn't say that, but he did. He said 2022 rates are going to go up, what I've been calling for. So you would expect rates to go up. They're down today.
Mike, what is going on? What? Like, I watched it and I'm sitting there and literally I have that on my phone because as we've discussed, I'm actually refinancing a portfolio right now.
Yeah.
And so I'm watching that 10-year every single day. And I'm sitting here looking at my phone right now as we speak.
Dude, it's down
to 1.455.
I got it. No explanation. The Fed has to be the buyer of last resorts. But I do want you, I do have to appreciate now. I'm actually getting, there's a fair amount of people calling for the 10-year to be at 1%.
Unbelievable. Well, then we're talking spreads, right, Mike? I mean,
2s and 10s, right? The yield curve's flattening. And if the 10, so 2s and 10s, right?
Yep.
Generally speaking, you should get higher interest the longer the debt is.
Yes.
Generally speaking, right?
Yes.
And the higher the spread, right? 2s are at say 1, 10s are at 2. I'm just giving you numbers.
Yep, correct.
That's a 1 point spread. The higher the spread, generally speaking, the healthier the market, right?
Correct.
That's how it should work.
Correct.
In theory, right? Locking up longer term debt, you should be paid more. What is happening now is you are seeing a drastic flattening of the curve.
Correct.
Generally speaking, that's not normal. It does happen. Not normal. Generally speaking, not a sign of a healthy economy.
Nope.
When it costs the same to borrow short as borrow long, generally speaking, not good. What we need to watch for is, heaven forbid,
inversion.
It tilts inversion, which we haven't talked about in a year and a half or so.
Yeah.
But dude, if it inverts, if you're getting 2% on 2-year money and 1% on 10-year money, folks, that's not good.
All three financial, poor markets or financial, I won't say collapses, but corrections, the last 3 significant corrections in the market were all followed an inversion rate between the 2 and the 10. Yeah.
The 2 and the 10 inversion is becoming a decent prognosticator. It's not always right. It's
within 18 months,
it's been more right than wrong.
That's right. Yeah. That's what, and as you know, what are market people looking at? They're looking at probability of correlation.
Yeah.
And when they correlate and you've got that inversion and then you see it and you say, okay, it's cheaper to get 2-year money or it's more expensive for 2-year money than 10-year money.
Yeah.
Then like what you talk about, that means that you've basically got an unhealthy economy.
Yeah.
And then what happens is within 18 months, the last 3 times that has happened, there has been a significant market correction.
And let's be really clear. There's a whole industry called the financial industry that is built on a yield curve.
That's right.
Banks will be crushed.
Yep.
If short is higher than long. That's their business model breaks. Just does flat out breaks if that happens.
That's why it creates that market correction, is because it upsets the apple cart across the entire financial industry.
And banks have to start acting differently, and lending gets super tight.
Yep.
Because why would they lend in that environment? Why are they going to go give you 30-year money? It's frankly scary to think about. I think it's scary to think about the 10-year at 1% again. It was at 1% during the beginning of this crisis, which made total sense. We just shut down the world's largest economy.
Yeah.
Damn, we're scared, right? When the 10-year goes to 1%, generally speaking, we're scared. We're nervous. We're fearful. It's not a great feeling.
No.
And I have some very vocal people on my channel now saying it's going there.
And then,
I don't believe it, but it's happening enough where I got to at least think about it.
So what would it tell you if we get to that 1 or 1.1, 1.2, because that's a significant drop even from where we are now.
Yeah.
But if we get to that number, what does that mean for mortgage rates? Because they're correlated and they follow each other, and then rates will come down. But with all the money that's in the market, with everything that's going on, all I'm seeing is bigger spreads. The difference of what the 10-year is and what the bank is charging. I'm just seeing much wider spreads.
I think the average investor won't see rates much lower than today.
Yeah.
Right. There's a floor in rates because of the cost of Dodd-Frank and all these other things. I think we're really close to it. But if you're an ultra high net worth individual, you could start getting rates, I mean, much lower. Right. I think what will happen is banks will be very, very choosy.
Yeah.
Which it means for most of us, probably you and I included, we're not going to see rates below that. I mean, it would have to be somebody 10x where we are.
Oh yeah, it's the big bigs. It's the Kent McElroys.
Yeah.
It's the Grant Cardones. It's
exactly
the big guys on the big properties, because at that point the government's looking for a good operator.
They want to replace stuff.
Exactly.
They want more and less, if that makes sense, right? More money and less assets.
Correct.
Would be my guess.
Yep. Mike, it's a scary, crazy, and amazing time, but the one cure for all of this is 30-year fixed rate debt.
30-year fixed rate debt. And let's be clear, right? This has been a very interesting conversation, but again, just today, what did Wells Fargo do? Wells Fargo came out and said, you know what? We expect the 10-year to pop in the next 30 to 45 days. They are calling for the 10-year to end this year at 2.2. Oh, so yes, there are people calling for 1. There are, I suspect, more people calling for 2.2. I'm calling for 2. So Wells Fargo's even above me. And if you ask the question about mortgage rates will be north of 4.
That's right.
I think they're going to be north of 4 by the end of the year. We had a conversation yesterday. I think they're north of 4. Yep. But I just want to appreciate there are calls for it to go the other direction. And you'd be foolish not to at least consider it. But I think rates are going up, but we'll see.
Well, and so I don't disagree with you. I think rates are going up as well. The key to this is 30-year fixed rate debt.
Every time, right?
Every time. 30-year fixed rate debt every time. Because again, the strategy of buying for appreciation is luck. It's luck. It's luck.
Luck and timing, yeah.
It's luck. If you're buying for appreciation, it's luck. If you're buying for cash flow, it's math.
Math.
I like math.
Me too.
I cuddle up to math. Math and I are close, very close.
I like having a right answer or a wrong answer, frankly.
Just based on the number. Don't give me a feeling. Don't give me a prognostication. You know, the market makes people look really stupid all the time. Mm-hmm. And it's because they think, they feel, they suspect, they believe that it might be. No. What is the deal now? Evaluate it now. Look at it now. What are the numbers now? Because your 30-year fixed rate debt is going to be what it is.
Yeah, it's done. Fixed. Yeah,
take it off. What it is.
There's enough risk in the real estate investing. You don't want your debt structure to be one of them. What was the 08 crashes? It was a debt structure problem. Multifamily going to blow up? It's a debt structure.
That's right.
Remove it from the equation. You're so right.
100% agree. Mike, where can everybody find you?
One rental at a time. Go to your Google search bar and you should find my website, YouTube channel, book, Instagram, all that good stuff. Spectacular course. Which you are a part of. Thank you.
Yes. It's a pleasure to be a part of. Dion Talks from yesterday, also a part of that.
Yeah.
You know, really good with self-managing stuff.
Yep.
Now you might feel in the course that you might be wrong, but you'll be right at the end. And that's what's important. So Mike, thanks so much for the time. We'll talk soon.
You got it, brother.
Take care.